Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about modern portfolio theory and how you can maximize your risk adjusted returns within the cryptocurrency asset class. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com, where you can, of course, get access to the tool that we'll be going through in this video. Let's go ahead and jump in. Now, in an ideal world, we would have a crystal ball that would tell us where the prices of various cryptocurrencies are going to go, right? In an ideal world. Unfortunately, we have to all sort of have this admission to ourselves that no one knows where the market's going to go. But as an investor, we would like to calculate out our risk adjusted returns for certain types of portfolios. This means that we're saying, look, I don't know where the market's going to go, but if it's going to go up, I want to have exposure to it. And how do I maximize my risk adjusted returns? So for every unit risk I take on, I want to maximize the return that could come from that. Now, a lot of people just think in terms of returns, right? Sort of, going to the casino in Las Vegas and betting it all on black or red. But in crypto, there's sort of a mathematical way that we can go about doing this, and this is not unique to crypto. Modern portfolio theory, classical portfolio theory dates back several decades. Now, in this case, what we're doing is we are plotting out the expected return of a portfolio versus volatility. All right? The expected return versus volatility. Now, the way we're calculating out the expected return is dubious at best. We're just basically plugging in historical returns and projecting those into the future. Again, it's dubious at best, but everything we do is dubious, so why not continue on with this? Also, note that when you're looking at historical returns, you can only go as far back as the newest asset, right? So in this case, ETH, was launched in 2015, so we can't even use any price history for Bitcoin before 2015. You might say, well, this is unfair because Bitcoin was going up for a long time before ETH was even around. This is excluding all that data. So all the price history for Bitcoin before 2015 isn't even going into these calculations. So what we're looking at here, you see all these little dots on the screen. This is displaying about 5,000 simulations. We ran 50,000, but we're showing 5,000 on the screen. And each one of these dots represents a portfolio consisting of some amount of Bitcoin and some amount of Ethereum. Now, the secret sauce potentially for a lot of hedge funds would be to, instead of use historical returns to project out future returns, they might just put in what they think the future returns are going to be, right? And then they can look at historical volatility to then figure out what their ideal weights should be for their portfolio. But in this case, we're not doing any of that. We're just saying, all right, we know crypto is cyclical. This is what it did in the past. What if we plug in the numbers? All right. So I'll scroll down in case you're not a member of ITC Premium and you want to read about some of this stuff. Here's the description. But we're going to talk about things like the Sharpe Ratio, the Sortino ratio, minimizing your volatility, and we're also going to talk about things like the efficient frontier. But the efficient frontier doesn't really become relevant until we start looking at portfolios with more cryptocurrencies in them. So in this case, what we're saying is, if I want to maximize my risk-adjusted returns for a portfolio consisting of only Bitcoin and ETH, what weights should the portfolio be? Right? What weights should it in fact be? Now, you go over here and you find the column that says Sharpe Ratio, and you scroll down until it says max. Okay? 0.869. Okay? So the maximum Sharpe Ratio for a portfolio consisting of Bitcoin and ETH, based on what we have here, 0.869. This portfolio would consist of 79% Bitcoin and 21% ETH. Now, that might sound somewhat sacrilege to you to suggest that the portfolio that maximizes the Sharpe ratio is only 21% ETH. But if you're new here, you should know we just spent the last 3 years talking about things like Bitcoin dominance, right? And the reason why we spent so much time talking about it was to maximize our risk adjusted returns, right? So we knew that for every dollar you don't put into Bitcoin, there's some opportunity cost there. It's not to say that the other asset you buy can't go up. It's just to say that what if it does go up, but it doesn't go up as much as Bitcoin? So for instance, I've said for years that ETH Bitcoin would go to 0.03 to 0.04. Right? For years, I've said it, and I said for years that Bitcoin dominance would go to 60%. A lot of people didn't believe it, but both scenarios came to pass, right? Bitcoin dominance went to 60%. ETH Bitcoin right now is sitting between 0.03 to 0.04, right? So the reason why this stuff is important is because ETH Bitcoin dropped about 64% over the last few years. So even though ETH USD is actually not that far away from its all-time highs, it's still 64% down against Bitcoin, at least up until a couple of weeks ago. Now, it has recently bounced, but it's still about 57% down against Bitcoin. So for every dollar you put into ETH over the last few years, that was a dollar not going into Bitcoin. And so again, it had nothing to do with what I wanted to happen. It was more so, guys, this is what happens every market cycle, right? Every market cycle, Bitcoin dominance goes up for a few years, and then normally it goes down in the post-halving year, which would be next year, okay? So going back over to this tool, it says that the portfolio that would maximize your Sharpe ratio would be 79% Bitcoin, 21% ETH. Now, a few years ago, it would have been a little bit less Bitcoin, a little bit more ETH, because ETH had been outperforming Bitcoin for quite a while. But fortunately, if you follow this channel, we said, no, ETH Bitcoin is going to go to 0.03 to 0.04. Therefore, it makes sense to be heavier Bitcoin, at least until that time, right? At least until we get close to the post-halving year. Now, I always have sort of an issue with the Sharpe ratio. I know a lot of people use it, and it's not a bad thing. But my issue is that it punishes positive volatility. Okay, so you see the x-axis? We're sort of saying that volatility, in this case, is our risk, right? Our risk, okay? Which is fine, in my view, as long as volatility is measuring negative volatility. But in this case, it's also measuring positive volatility, and it's punishing positive volatility in calculating out the risk-adjusted returns, right? So if you held an asset and it went up 2x really quickly, and then you're looking at your risk-adjusted returns, it went up, but it's also that positive volatility also, kind of works against it a little bit. So there's another metric that you can use that I think is a little bit better, and it's called the Sortino ratio. Okay. Now the Sortino ratio is maximized at 1.057, and it actually suggests 82% Bitcoin and 18% ETH. So it's a little bit more Bitcoin, a little bit less ETH. Now, let's say you don't fall into either of those camps. Let's say you don't want to maximize your Sharpe ratio. You don't want to maximize your Sortino ratio. You want to minimize your volatility. Well, the volatility for the assets of Bitcoin and ETH, the portfolio that minimizes your volatility, is 93% Bitcoin and 7% ETH. Okay? So there's a lot of ways you can go about sort of crafting a portfolio based on your risk-adjusted returns. Now, your risk-adjusted returns do not always reflect the maximum return that you can in fact get. It's the maximum return per unit risk that you're taking on. So, in this case, if we hover over some of these data points, you can see right here, it's about 80% Bitcoin, 20% ETH, right? 80-20. But as you go further up the efficient frontier, you can see it becomes less and less Bitcoin and more ETH. That doesn't mean you necessarily make less money. Of course, it would have meant that over the last 3 years. The more ETH you had, the worse your portfolio did, because Bitcoin dominance went up and ETH Bitcoin went down. Hopefully that changes in 2025. I think it probably will. So what it means though is that over here, your expected return for a portfolio of 80% Bitcoin and 20% ETH annualized is going to be about 62%, right? About 62%. But again, it's plus or minus 70%. So some years, it could go as high, so within the one standard deviation, right? I mean, it could go as high as over 100%. You could even have a loss, and it would still be, sort of projected by this to within one standard deviation. That might sound like a lot, but guys, it's crypto. What do you expect? I mean, if you can wake up one morning and a meme coin's up 500%, then you have to be willing to accept that there's going to be a lot of volatility. It's the game you play. That's the reason you're here. All right. Now, if you want to take on more risk, you can do that, and you can go up the efficient frontier higher and higher and higher and higher and see that, all right, maybe you want to go after an expected return that's 72.5%. The problem is, it's 72.5% plus or minus 100%. So the range is a lot more, right? The drawdown could be bad, but if the market is healthy and you get your alt season, then the upside is a lot greater. Now, again, over the last few years, the people that went higher and higher up the efficient frontier and took on more risk, they were not rewarded. Because as we showed, ETH Bitcoin went down, right? They were not rewarded. So it doesn't always pay to take on more risk, right? Sometimes it pays to take on less risk and to just, stay with Bitcoin. I do think next year there's a good chance that ETH will go up against Bitcoin. But this is what we've talked about for the last few years. Now, I know what you're thinking. You're probably thinking, well, hold on a second, Ben. You just ran 50,000 simulations. How do you know that you ran enough simulations to actually calculate out what the portfolio would be? Maybe if you'd run 100,000 or 1,000,000 or 1,000,000,000, you would have found out that, maybe it did require to have more ETH to actually figure out what your maximum Sortino ratio was. It's a fair question, but with this stuff, you can use something called quadratic programming to just solve for the portfolio. So you don't actually have to go through this Monte Carlo system, simulation. You don't have to go through a Monte Carlo simulation to then figure it out. You can solve for it identically using quadratic programming, and so that's what we did here. So I know that's going to be a question. It tends to come up. Just telling you now, this is calculated out using quadratic programming, not the Monte Carlo based approach. The Monte Carlo approach is just being shown for aesthetics, right? Just so we can visualize the efficient frontier. But it's not, these numbers over here are not coming from the Monte Carlo simulation. Now, what I want to do is really we have to add in a third asset because, this only gets you so far, Bitcoin and ETH. So we have a few assets over here that we can add in. Let's start off with XRP, right? It's right here. Let's go ahead and recalculate it out. We're going to add in XRP. It obviously went up some recently. I'm sure there's going to be some interest in it. By the way, over on ITC Premium, we talked about XRP right before it went up, right? And again, we identified the double bottom of XRP against Bitcoin, right? Against Bitcoin. And that was the important thing to note. And this is, I know a lot of people don't really like thinking in terms of their Bitcoin pairs, but when you find altcoins that are essentially double bottoming on their Bitcoin pairs, that's usually when they get these aggressive spikes up. Okay. I mean, and again, this is a common thing. I mean, even with ETH Bitcoin last cycle, we saw the same thing, right? I mean, it was a double bottom, and that's really what you want to see. So when you add in XRP into the mix, it's kind of interesting. And again, the great thing about this is that it doesn't matter what I think or what you think. It's all about what does the math say, okay? So don't get mad at me, right? Take out your frustration on maybe someone else's altcoin, all right? But according to modern portfolio theory, the Sortino ratio is maximized 82% Bitcoin, 18% ETH, 0% XRP. That might seem a little ridiculous, right? I mean, XRP just went up 3x. And if you followed the XRP Bitcoin valuation, you cashed in on that. So then how can this possibly make sense, right? How can this possibly make sense that it would suggest 0% XRP? For me, what it suggests is that XRP is not as good of a long-term hold as Bitcoin and Ethereum. That doesn't mean you can't make money on it. Absolutely, you can. In fact, a lot of us just did, right? A lot of people did just make a lot of money on it because we saw XRP Bitcoin double bottom. It also had the same rally in November of 2020, and you can make some money on it. But why? Even if XRP can go up 3x in such a short period of time, why would this suggest 0% XRP? Why would it possibly suggest that? Well, the reason is because if we go back over here and look at XRP Bitcoin, right? XRP Bitcoin, as nice as this move was, by X, you can see I've marked this chart up before, right? As nice as this move was, XRP Bitcoin just hasn't really gone anywhere in a long time, right? Like, this is a nice spike. Don't get me wrong, right? It's a really nice spike, but it had a similar spike last cycle. The problem, is if you look at things like Bitcoin dominance, it's been going up for a long time, right? If you were to look at XRP dominance, yes, it did get a spike recently, but if you look at this back in 2017, XRP dominance was 31%. Today, it's a little less than 4%. So no one's denying that XRP just had a really good spike. It did. And I honestly, I truly hope some people caught that move. The problem is that even though it made that move, since 2017, right, even though it made that move, since 2017, if we were to measure this out, it's still 90% down against Bitcoin, right? And that's the hard part of investing in crypto, is that so many of the altcoins follow this trajectory. That doesn't mean they won't occasionally spike. And it's always possible that it gets a more aggressive spike. But my point is that in terms of crafting a long-term portfolio, there are your blue chips, which are definitely Bitcoin, and arguably Ethereum as well, right? I think Ethereum is a blue chip. Obviously, some people would disagree with that. But modern portfolio theory wouldn't disagree with that, because even XRP, which just gave us a 3x move in a really short period of time, modern portfolio just says, meh, who cares, right? So what? I found a quarter as well. The Sortino ratio is maximized with 0% XRP. The Sharpe ratio is maximized with 0% XRP. That doesn't mean you should never hold it, right? There's money to be made. It just means that, it might not be the best long-term investment. And there's going to be a lot of people who are going to listen to this and be like, well, last cycle, the returns got muted because of the SEC suing Ripple. And I'm not disagreeing with you, right? I'm not. And I even pointed out this XRP rally before it happened, right? I'm not against it going up. It's just that, do you want to be the person, right? Do you want to be the person that sat in XRP for 7 years just to see that little move and say you were right? Or do you want to be the person that, stuck with Bitcoin and then see this double bottom, take a little bit of risk, and then get a 3x return in 2 weeks? This is the argument, right? It's not, the people that have held XRP for years are doing fine right now, right? They're doing fine. But the point is that they've had to hold through all of this, and it still isn't really necessarily any different than what we've historically seen. Hopefully it does go up, right? I actually do think it'd be nice for XRP to see more upside. But at the same time, there's a difference between what do you value your portfolio in? Is my unit of account ETH, XRP, US dollars? No, my unit of account is Bitcoin. Because you see what altcoins do against Bitcoin over a long enough period of time, right? And even in a world where XRP Bitcoin comes back up to the top of the range, that'd be great. But the inevitable outcome would be likely that it would just bleed back down again. And one of the ways you can also visualize this is to look at Bitcoin USD over the last few years, right? If you look at Bitcoin USD, you can see that it's just been generally trending higher. Let me get one with a little bit more history here. So if you look at Bitcoin USD, you can see that it's, you have your 2017 peaks, you have your 2021 peaks, and now you're all the way up here in 2024. If you pull it up for XRP, here's your 2017 peak, here's your 2021 peak, and then now you're at 2024. I have to imagine there's someone that bought XRP in 2017, 2018, and they just checked the price. They're like, it's the same price as it was, all those years ago. So again, it's easy to sort of, for people to fall into they're attacking my altcoin. Everyone's here to make money, right? Just don't marry an altcoin. Don't be the person that just kind of sits in it for years just to wait for a rally when you could have just stuck with Bitcoin until it got to higher dominance levels and then take on the risk. And that's why modern portfolio theory is so useful. It helps you to identify the better longer term holds so that, for the shorter term holds, you don't get stuck married to those altcoins and you watch them draw down, say 70, 80, 90%. Now, in this case, that doesn't mean that you can't find a portfolio that does call for some XRP. This green line up here is the efficient frontier. Okay, this, you could even think of the red line down here as the inefficient frontier, although I don't think they actually call it that. But the green line is the efficient frontier. So if you want to, let's say you want to make your expected return, you're going after 65% annualized. Okay, then you're going to want to come across the screen right here and find this portfolio, right? So that would be, 57% Bitcoin, 41% ETH, 4% XRP, right? So you want to be on the efficient frontier. What you don't want to do is be down here on the inefficient frontier. Because here, you're going after a return of 65% plus or minus 77%. You don't want to be down here going after an expected return of 55% plus or minus 77%, right? You see the difference? You want to make sure that your volatility is as low as it can be and your expected returns are as high as they can be. So you can go all the way out over here on the efficient frontier and say, you know what? I don't want to maximize my Sharpe ratio. I just want to take on some risk. And to hell with risk. To hell with calculating out my Sortino ratio. I don't want to worry about that. I just want to take on some risk, but I want to make sure I'm on the efficient frontier. I don't want to be on the inefficient frontier. For instance, if you were on the inefficient frontier down here, it would suggest, 9% Bitcoin, 3% ETH, and like 87% XRP. That's a really difficult portfolio to look at, over the last 4 or 5 years because XRP just has bled to both Bitcoin and Ethereum. But you would like to go up here and see what those portfolios would consist of. Does that make sense? So for every unit of volatility or risk you're taking on, you want to go up as high as you can on the chart. So if you want to take on expected volatility of say 80%, you want to go as high up here as you can and find the portfolio that maximizes your expected return at 80% volatility. Does that make sense? That's the idea. Okay? Now, we could throw on some other assets here as well, right? We could look at Litecoin. Now, let's calculate it out with Bitcoin, ETH, and Litecoin. And let's see if it gives us anything different. It doesn't, right? It's still 82% Bitcoin, 18% ETH, 0% Litecoin, right? Or for the for the other one, the Sharpe Ratio, 79% Bitcoin, 21% ETH. It is what it is, and I don't control what it is. So don't get mad at me. This is just classical portfolio theory, modern portfolio theory, right? It's all about just looking at what it's done, right? I mean, I don't care what you think it's going to do. I just want to know what it's done before. And I will then figure out, based on that, and looking at its historical volatility, if it deserves a spot in my portfolio, a long-term spot. That doesn't mean you can't take short-term trades. Absolutely. Yeah, I'm not gonna argue against that, right? And just because I say dunk on Litecoin or dunk on XRP doesn't mean that they never deserve a spot in your portfolio. In fact, normally in pre-halving years, Litecoin does pretty well for the first half of that year. Litecoin also usually does pretty well in post-halving years. Okay, I mean, we saw major peaks by Litecoin in 2017 and 2021. So I'm not suggesting that you never have them, because there are times where they could make sense. But is it a long-term hold? Probably not, right? I mean, again, if you were to go carry out the same exercise that we just did with XRP, but with Litecoin, look at the Litecoin Bitcoin valuation. Every time I look at this, it just goes down more, right? So the last time I looked at this, it was down 96.5%. Since then, it went all the way down 98% almost. Now it's back up to only being down 97% against Bitcoin, right? So over the last, since 2014, Litecoin is down almost 98% against Bitcoin. So do you want Litecoin to be your unit of account? No, because it bleeds against Bitcoin. Some people say, well, what does Litecoin do best? Well, what it does best is bleed against the king. It's just what it is, right? That doesn't mean you can't make money on Litecoin. Litecoin does do well sometimes. I mean, it does. And in fact, if you were to overlay Litecoin with XRP, you can see they generally track each other. Not always. There are some deviations where one gets a spike up and the other one doesn't really see that same spike. But the point is that, you can still sort of respect an asset and respect how it moves at certain phases of the cycle, but also not treat it as your unit of account, because over a longer period of time, it's going to bleed to Bitcoin and it's going to bleed to Ethereum. And hell, since 2017, ETH has been putting in lower highs against Bitcoin. It's also been putting in higher lows since 2015. Lower highs, higher lows. Litecoin's just been putting in lower highs and lower lows, right? At least ETH has been putting in higher lows. But I don't know what to tell Litecoin. Hopefully it does well. Again, if it follows XRP, it could spike. But the point is your unit of account Bitcoin, or is it something that bleeds against Bitcoin? And we're likely going into a year where dominance will likely go down a lot at some point next year, right? So you should remember that if and when that happens, don't forget how the market cycle works. If the alts spike against Bitcoin, they will eventually come back down to earth. Bitcoin is the unit of account, not the altcoin market. The last thing we'll look at here is US dollars. So if you throw US dollars onto the same calculation, just, because people are always like, well, how much cash should you have on hand? What should you do? And it really depends on how much risk you want to take on, right? I mean, you could make an argument, some people might only have no cash, right? They want to be fully deployed. They're all in, Some people might say, I want, 10% cash. Some people might say they want 20% or 30%, right? So it all depends on what you find important, right? And I can't tell you what that is. What's right for you is not going to be right for someone else. So just think about how, this stuff can be useful to navigating the asset class. And that way, if you ever get to the point, and I'm not talking about just right now, right? I mean, everyone wants to know about right now. Guys, this is a tool that you can use for years and years and years. At any given point, if you want to put money into crypto, you should at least think about your risk-adjusted returns. And think about, over the next 6 months, what do I expect? Well, what do I expect over the next 4 years, right? In 4 years, is Litecoin going to be at a higher valuation against Bitcoin than it is today? Probably not. Could it be at a higher USD valuation? Yeah. But it's all about opportunity cost, right? And $1 into Litecoin or XRP or Ethereum or Bitcoin, where do you want to put it? And there are times in the cycle where Litecoin and XRP and Ethereum outperform Bitcoin. And there's a good chance, you could see some of that happen next year. And XRP has already been outperforming Bitcoin the last few weeks. But it's all about making sure that you don't go through 3 years of the cycle just watching your altcoins bleed to the kink. And that was sort of what I wanted to impress upon everyone by following Bitcoin dominance all these years. And I know a lot of you guys have no clue what I'm talking about with regards to Bitcoin dominance because you just joined the cryptoverse. But don't worry, you'll find out at some point in the market cycle when Bitcoin dominance also teaches you the cruel lesson of how the altcoin market behaves. But until then, just remember that there is sort of a rhyme and reason to all this stuff. There is a cyclical component to it. And while it does seem like altcoins at phases of the cycle only outperform Bitcoin, just remember there are about 3 years of the cycle where most alts bleed back to the king. We saw it happen in 2022, 2023, and now we've seen it happen again in 2024. My guess is you'll see altcoins potentially do better against Bitcoin next year, but we'll probably repeat the process we just had in 2026 through 2028. But anyways, guys, that'll wrap it up for this video. Make sure you tune in next time. Please subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.